You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Good morning, everybody. I'm your first surprise of the day. Not only I'm not Oleg Solodukin, but I have Mr. Bean over here. Mr. Bean forgot his phone, unfortunately. We were afraid that Beyonce would start singing in the middle of the Andy presentation. Oleg Solodukin is the newly appointed CEO of DXV Data Solutions Dev Experts. He is actually sitting over there, but he'd had 7 pounds of Branzino and 24 mojitos, and then he smoked some of those absolutely fantastic Mayak cigars, and he has no voice. So he asked me to be here today to introduce the panel. DXFeed is the newly formed data division of Dev Experts. Dev Experts has been around for 20 years now, and we work in the back stages of the industry, which many of you, to make you more successful, more competitive, and bring to market much faster solutions. DXFeed, the data services, I'm proud to say that today has over 6 million end users, retail and institutional, received over 25 awards all over the world in design, user interfaces, in functionality, and we have, I think, would say the broadest array of data services in any company in the market. I think that's it. I would like to hand it over to Andy. It's to introduce the industry leaders panel. Andy? There's a little bit of yes. I think Andy.
Thanks.
Thank you very much. All right, very good.
Yeah, why don't you guys come on out, and I'll let you introduce yourself. Sorry. I'll reserve the chair right here, though. Where do you want me? Just anywhere on the end. I get to sit down now, so this is a lot easier. Thanks. Well, I'm excited to be moderating this panel today. We got a lot of new faces, and want to hear their perspectives on the industry. With what's going on, some of the wins. I think you guys should all pat yourselves on your back, the exchanges as well as OCC for doing so much to make this market resilient and really build this market structure that kind of showed its mettle in the past year with all this vol and all this increased trading activity. So I think it's great that we're in the place where our record volumes, as Henry had showed on his slides, and kind of we're in a good place right now. But to start us off, I really just wanted you guys to introduce yourselves. There's some new faces, as I mentioned before, and I'll just kind of, if you can introduce yourselves and your role in your organization, that'd be great. John?
Sure, hi. I'm John Fennell. I'm the Chief Risk Officer for the Options Clearing Corporation, and really excited to be here today.
Hi, good morning. I'm Greg Ferrari. I'm a Vice President in the U.S. Options business, responsible for our product and business strategy.
Shelley Brown, my exchange group, EVP, Business Strategy.
Good morning, I'm Patrick Zielinski, and I'm the SVP of Market Operations and Technology, and I'm primarily responsible for aligning the business strategy and executing on technology.
Good morning, Ivan Brown. I'm Head of Options for NYSE.
Ariane Cricky. I would call myself the newbie Senior Vice President with SIBO. I'm overseeing the U.S. listed options business as well as our global client services distribution effort.
Great, thanks guys. It's great to see new faces up here, and it's almost like a changing of the guard in this industry. I've done these panels before, and I think this is the first year I'm the oldest guy on the panel. So
I doubt
Sure,
it.
the world has changed. Oh, no, I got you. I got you all. So it's as I said, it's great to see you guys in this place. But you know, let's start this thing with a positive kind of aspect, right? We've built this marketplace. There's all these risk controls, all the things that your firms have done to make the market a much better place today. What are some of the benefits that you guys see from all this investment, all this oversight that what the OCC has done? And I'll kind of throw that out there and let anyone kind of grab that to start with. What are these benefits that we're going to see from not only now but in the future from all these investments you made?
I think it's a safer marketplace. It's safer for the market makers. It's safer for the retail investors, safer for the institutional investor. Things like trade-through protections. We used to see market orders come in and run the market points. That doesn't happen anymore. The market makers, they were able to provide more liquidity because of the risk protections we all provide. OCC has done a great job supporting things like modifying the give-up agreements. There's a lot of protections that have been brought to bear in the market that I think makes it a much more stable market.
I think it's.
Go ahead.
I was going to say, I think it's also, resiliency and capacity. I mean, when you think about it, last year, especially in Q1 and Q4, you had unprecedented levels of volatility, and obviously, as many have said, it was a record volume year. And, for the most part, the options market handled it very smoothly, right? And that's a testament to the fact that everyone in this room has invested incredibly in terms of the resiliency and performance of their technology, and that's true of me and my colleagues up here on the exchange side as well. And it's, those types of things where you can handle those events and, the liquidity is available to folks, that inspires investor confidence, which ultimately increases engagement, which I think is a good thing for everyone.
Yeah, I think it's that resilience and the risk controls that people have put a lot of effort into in the industry. And I look at the vol disruptions that we had last year, and the market handled it with ease, which was fantastic. Henry's slides talked a lot about the performance and obviously a great year for everyone. And quite frankly, even Kurt Eckert was smiling last year, which that doesn't happen much. But, we look at these risk controls that we've all worked very hard on. And I think that I challenge everyone, or we challenge ourselves right now, that I think they have set the stage and much better than probably what was been in place maybe 10 years ago, and the efficiencies of the marketplace. But I think we all agree that they can be furtherly honed, they can be improved, and I think that we can challenge ourselves to continue to make tweaks to some of the things that we put in place, including even just like the obvious error rules and things like that.
One thing I'll add here, I agree with all my panelists, is that, in the multi-list environment and our feature set being unique to each market model, what we've done is we've created backups for each other, if you will. We have 11 complex order books, or soon to be by year end. We have 11 price improvement auctions. So if one exchange does have a system issue, we want to get our participants out of the way and notify them immediately that they could use another facility from us or one of our competitors, so that there's no disruption to the end user with their experience, what they need to do in the marketplace. So I think we're running live backups for each other for the marketplace, so that there's no disruption to the end user. I think that's an incredible development that we all benefit from.
Yeah, I think you see the awareness of the debt that we carry as an industry from market disruptions, and I think that kind of coordinated effort between all the exchanges and the market participants to identify what are those higher order kind of opportunities to attack, and the collaboration you're seeing, everybody's championing the same message, that's really pushing us forward, and you're starting to see that manifest itself in how resilient the environment is.
I would just say the exchanges, obviously we all have our technology in place to permit the firms to establish the controls, but it seems like they've also gone through and improved their internal systems as well. So you have the guardrail of the exchange, and then you have the internal systems of the firms, and it seems like when you weave all those together, it's a lot more robust system in general in terms of risk control.
Have we gone too far? I mean, is the investment, what are some of the costs that you guys are seeing the greatest cost increases in industry from your chairs, from your seats with respect to this evolution and all this investment frankly, the complexity, and actually complexity can be a good thing, as you mentioned, Greg. But what are some of the costs, and where do we need to keep an eye on from an exchange standpoint?
Regulatory costs.
Bingo.
It's the biggest burden on the exchanges. I understand the SEC's concern with having a viable marketplace, but some of the things they're asking for are just over the top, and we're all having to divert resources away from new functionality, away from new ideas to comply with some aspects of Reg SCI, the backup requirements, the reporting requirements. It's just onerous. It's an incredible spend and an incredible use of resources that could be used for other productive things.
I think fragmentation would also be another type of cost that's present in the industry. I think in general, with the consolidation amongst the ownership groups, it's gotten a lot better in terms of streamlining those protocols, but still the liquidity is fragmented, and that does present a cost to liquidity providers.
Well, and I guess that's a multi-factor kind of conversation, right? Because there's fragmentation in the form of product, which I think, there's industry efforts right now to try and address that through right sizing or thinking through strike listing programs, and are they in the right place, and are they reflective of today's market structure? I know one thing that we certainly worry about at NYSE is, excessive, venue fragmentation. From our point of view, I guess we have a unique vantage point because we only operate 2 markets, although there are markets of scale. And so if you look back over the course of the last couple of years, since 2010, I think we've had 9 exchange launches. As of April, we have 3 exchanges at or under 1% market share, 5 under 3, and 8 under 5. And so, when you think about that, a number of those launches have been compelling, and a number of them perhaps less so, just because they're not as differentiated. And so, from our point of view, there is an interesting sort of market force distortion here where an idea isn't solely able to compete on its merit. And so I think from our point of view, the notion of competition is absolutely welcome. It forces all of us to innovate, and that's healthy and good. At the same time, I think, NYSE would certainly be open to an industry dialogue that looks to balance the notion of enhancing competition while at the same time looking at what the benefit versus cost analysis is for the industry of an individual venue. So.
Yeah, and I'll take, with respect to when we acquired the ISE in 2016 and we canvassed our participants about what they wanted to see from us, they wanted to see a consistent, holistic approach to our tech stack and what they're facing off with. So common data feeds, common API, so that they could simplify their code base and interacting with the exchange. So when we acquire the 3 assets from ISE and we go through a sequential migration, now we have one common code stack for that set of platforms. I think the industry welcomes consistency, and they want to see things harmonized, but also you say the costs associated with that. What we think about is fragmentation and the concentration risk relative to the cost of quoting into those markets. And there is an implicit cost. There's also explicit costs as well. And we feel that if we can use these medallions to utilize for innovation in the marketplace, we have them, and we want to explore those challenges. But we have an uphill battle with the regulator to figure out what we need to do to be able to convince them that there's an opportunity to create new product in the marketplace.
I think the industry's, I'm sorry, go ahead.
Yeah, thanks. Well, I think that obviously you touched upon, Shelley, you touched upon in particular the cost, the increasing cost from a regulatory and a compliance perspective. I actually think that there's a greater impact that is more evident as it pertains to our market makers and the just the limited number and the attrition that we've seen over the last couple of years. And I think that SIBO has spent a significant amount of time working with market makers, as well as my colleagues up here, as well as the clearing firms. But the crux of the problem is the bank capital rules. And we've talked a lot about this. You've heard even yesterday, as well as in some of Andy's presentations, about some of the major impacts of regulatory problems. I think that the current method, which is the current exposure method, which really struggles with how to properly price risk offset option positions, and it is the crux of this regulatory problem and this bank capital that's constraining the overall industry, and quite frankly, creating barriers of entries for more market makers to actually re-enter the market, hopefully re-enter the marketplace. I think that as we look forward, and I'm sure John's going to speak a lot about this from an OCC perspective, and we look forward to potentially the new version of that with SACR. SIBO is fully supportive of that model. While it makes maybe not a perfect solution, but is one that puts it into a place where you're starting to look at option positions in a more risk offsetting manner, while not going into the details. But I think it is something that is critical to the improvement of this industry, as well as the overall liquidity, because it's directly impacting a lot of our liquidity, all of our liquidity providers, and something that if we need to take a step forward, it's really looking closely at these bank capital rules.
Yeah, I think Ariane's completely right. I think it's even more so. I'd say the amount of time that we've been dealing with these onerous bank capital rules, non-risk-based, it's created an atrophying of our clearing member level, the market, the liquidity provider level, and that I think it's going to take some time to rebuild that back up once we finally do get through and have those new capital, the SACR applied. But it's going to take time. It's not a silver bullet.
Can you give us a little bit of an update of the timeline and where we are as an industry with negotiations with the Fed and the Treasury around the bank capital rules?
Sure.
Best position.
I think Julie Bauer gave a good update yesterday around our efforts around Capitol Hill on trying to get legislation passed through Congress. And while it might have not passed in the Senate, what it did do, and what the main point was, is that it did get the attention of the bank regulators to draft rulemaking to adopt SACR. And so you've got the three primary bank regulators. They've drafted that. It's gone through a comment period. I'd say from our perspective and an options industry perspective, it covers off the things we're looking for. I think there's some comments around unintended consequences around other areas that they're looking to address. And I'd say we're probably still looking at 12 months. It's probably a 2020 type of implementation, but I think once you can get that final rule passed and then the banks can start having some certainty around this is what the future is going to look like, then I think you can start seeing some of that easing back up.
So is it a regulatory fix or a legislative fix that we require?
I'd say it was a legislative attempt to try to drive and incent a regulatory fix, but it ultimately is a regulatory fix.
Mm-hmm. Okay.
And drawing a parallel to that, when we thought about the Fed being the regulator of these banks and applying more scrutiny with respect to sort of backdoor regulation of the risks of the clearing firms, that's what, with STA and SIFMA's help and thinking about unmitigated risk and what we can do as an industry to put in the appropriate safeguards, that's where I think us and our peers have worked really well together to identify that as an area that should not be a competitive issue, and let's put the appropriate controls in place for the authorized give-ups, which I know is not necessarily related to SACR rules, but it's related to just how banks are being scrutinized by the regulators with respect to use of capital. So I'm really glad to see that we're all working together on that and getting that approved.
Okay. So all these different changes, the capital and 16 exchanges and regulatory fiats and requirements, what impact has that had on overall liquidity and kind of as we look at the impact and the challenges around this market structure that's developed, once we move beyond that and grow the industry. But if we can talk a little bit first about kind of what impact it's had on liquidity, why it's why we hear so many complaints, particularly from the institutional side of the business, that they can't get the size they need. And with Henry mentioned before concentration, I think the top 130 stocks are 80% of the volume. So what are some of the impacts of this market structure that has evolved on liquidity, and how do we fix it?
I don't know if something needs to be fixed. I think the markets are very liquid. I think the market makers do a great job providing liquidity. I think there's a misconception on the street when they look at a screen and they see 1,000 contracts offered in a given option on 10 or 12 or 16 different exchanges, that they think there's 10 or 12 or 16,000 contracts offered. But the reality is there's a handful of market makers left. And those market makers represent their quotes on all 16 exchanges. And their intent isn't to sell 1,000 contracts on 16 different exchanges. They have 1,000 to sell. They just happen to represent them at each of the exchanges, but they split their volume up. And there's a game going on between some of the routers that are trying to capture all liquidity across all the exchanges and the market makers that are trying to show as much liquidity as they can, but not necessarily selling the full volume in all 16 exchanges simultaneously. And the perception by looking at the screen is different than the reality.
I think while I agree a little bit with some of the comments you're making, Shelley, I think that the crux of the problem actually comes from the proliferation of exchanges. I think that we are seeing significant amount of fragmentation because of the increase in number of exchanges, Shelley. But, and I think we'd all kind of agree up here that while we all as exchange members enjoy hosting OIC, but maybe the fact that if we had to host OIC once every 15 years, that might be better than once every 5 years. But that being said, I think that we have to look at the execution quality across for our end users and the ability for them to have only a finite amount of liquidity providers, and that liquidity is spread across multiple 16 exchanges now. You're starting to see a potential deterioration of quote quality as well as execution quality, and I don't think that's what we're trying to accomplish here with the number of exchanges that we currently have.
I think there's a confluence of factors going on. It's not just limited to number of exchanges. It's not just limited to the weekly series, and it's not just limited to the 990-something thousand strikes. But you have, the benefits as a result of the use of auctions is clear as day in the execution quality that's being delivered every day to retail. But the costs that are borne by the industry has resulted in a two-tier market, roughly, right? So what we bear as operators here is we're in the business of risk transfer in the price discovery process, and a lot of those marketable orders that tend to, over the last 15 years have moved more and more into auctions, have resulted in a deterioration of the willingness for market makers to make that market on the screen, because they know that there's a significant amount of adverse selection that results in being on that quote. So firms have to bake in a realistic approach of where they're willing to trade based on who they're trading with on the quote. So fragmentation is part of that, but also the factors that the result of auctions have also played a significant part in that.
I mean, I think there's a balance here, and I think I agree with some of the things that were said across the group. I mean, there is the notion of, I guess, making liquidity observable, right? Because, I think, last year, and I think we were talking about this a couple of weeks ago, we looked at a study that basically looked at quoted spreads as a percentage of the price of the option over time last year, and just looking at the study of the influences of volatility on that. And when you adjusted for that, we actually saw that spreads maintained a very stable sort of trajectory over the course of the second half of the year, which means that in theory prices appreciated in line with spread width, and so on a percentage basis things were fairly constant. And I think that's good, and it points to the fact that liquidity is available when it's sought. However, I think to Greg's point slightly, I mean, it's about making it observable. Certainly, no one would question that the quality of the retail experience today is excellent. And auctions are an important tool from a price discovery and liquidity perspective, but they shouldn't be the only tool. And so I think there's the notion of creating sort of balance, and maybe there's an opportunity to evaluate, what are the parameters and use cases of them, and providing an incentive or a greater incentive that the determinism of actually having your quote accessed will happen. And so then the other side of it, though, too, is we don't spend a lot of time talking necessarily about the institutional community, which perhaps might be a community that is slightly underserved in the current market structure, which then requires us to think about it that there isn't necessarily a one-size-fits-all approach. I think different constituents have different needs, and so I think we kind of need to evaluate it with that lens.
I'd like to address the fragmentation issue. Yes, there has been fragmentation. I was on this panel 9 years ago and was told we didn't need a 9th exchange. We've introduced 3 of the last 7. But the reality is we've raised the bar for technology, and all the other exchanges have gotten better in their technology as a result. Some have built it in-house, some have had to go out-of-house and buy it. But we've improved the marketplace in terms of technology, we've improved the marketplace in terms of risk, and competition is healthy.
So we've built this market. There's challenges that need to be addressed. How do we grow the market? I mean, you guys all alluded to different things: auctions, lit markets, and internalization in the auction process, and that captured flow. Retail's 15% of the market today. Institutions are playing a much bigger role, and the market's grown over the past several years as well. What's the best way to grow the market? I mean, we talk about market models. We have all these medallions out there. Is it time for an institutional marketplace? Is it time to kind of create a new animal that serves the needs of larger institutional investors that are looking for more size? I mean, you mentioned a two-tiered market, Greg. I think that's the auction, the lit versus the auction market. Do we need? I mean, how do we grow the pie? How do we get more institutions involved? How do you provide them more liquidity? How do you get more market makers in the business?
There's a lot to unpack there, but I think one thing that I really like that we've done is with the slide that Henry showed about the cross-asset ETFs and the prolific growth in rates product, credit product, commodity products that have come to our marketplace. Our platforms are built, our ecosystem is built, we are open for business. That has migrated to our market where it used to live within an investment bank or products that did not exist for retail that would be done in a fixed income environment. So the fact that volume is now coming to the marketplace in terms of the hard-to-borrow market or the reversal conversion market, what we're seeing in products like HYG or TLT, I think has been fascinating for us. So working with our ETF issuers and partners to create more product that suits the needs of retail institutional investors is a great thing for us. I believe we're on our path for new all-time highs in fixed income ETF inflows, and I think that continues to help our business.
Well, another interesting trend too, I think you and I were talking about it, was the fact that single names, equity names have now outpaced ETF on the option side of things from a growth perspective for now 2 years in a row, which I think is encouraging, whereas several years ago, we're spending a lot of time, obviously, in the migration to more passive investing. How would that potentially, impact sort of the, single stock option trading? And so I think it's nice to see that change. Certainly that's, helped by the fact that there's a number of names that are in vogue, and we have a healthy IPO market, which offers new, securities for people to engage with. I mean, Andy, to your point in terms of new participants, I mean, we also have seen new participants enter the option space on the retail side, about a year and a half ago. And, we have seen in some instances, new folks coming into the space that, on the market making side that either were much more focused in their strategy before, maybe they made markets in only a handful of names and are looking to expand their breadth, or maybe were more equity focused market makers, for a period of time and are now re-engaging in the options space. The only other thing that I thought was kind of interesting was, in a number of our client conversations recently, we've heard that there is increasing sort of interest from international audience, sort of, European domiciled hedge funds and things of that nature, and also folks that have been maybe accessing the OTC markets that find the transparency and price discovery and sort of regulatory audit trail of the listed options markets to be attractive. And so there's a confluence of factors there that help to buoy the industry. And it's interesting, when you think about it, last year between Q1 and Q4, the uptick in volume was obvious, right? Volume was, vol was high, volume was high, but then in Q2 and Q3, when vol was really low, we were still running at a 2 or 3 million contract ADV premium. Vol is very low in April, and yet we finished off in 16 and change on a multi-list basis, which is still 2 million higher than our 8-year average. So it's interesting you think about some of these other factors at play, and to the extent that is a new norm or not probably is yet to be determined, but those are encouraging things.
Yeah, I think even to play in that from an institutional perspective, Ivan, I think you raised some great points, and I think even another evidence of that from Henry's slide was as it pertains to flex options. So you see this growth in the institutional community, and even in my prior life, prior to joining Cboe, we were seeing a significant amount of growth, not only in further increased exposure in listed options, but also new participants in the institutional space. And that speaks obviously to Andy's increase in terms of 35% being on the institutional side of the business. There's further adoption there, there's further comfort, and the willingness to be able to expose capital using US listed options is important. But the one thing that I think was interesting from Henry's slides was that flex increase. And I think that's leading to the ability to have more flexibility in the listed marketplace. While we do think that there is a series, or there's a decent amount of trades and flow that from the institutional community in particular that still transacts in the OTC market, but you're starting to see that evolution, and the ability to use a flex option to maybe match or have that specific maturity profile that that investor needs was critical. So that also leads to the ability to have Monday, Wednesday, Fridays, or more weekly options, because they want the ability to expose that capital in the listed space. They recognize the liquidity is there, which is fantastic from our industry's perspective, and they want to migrate that flow out of OTC. There's a comfort with it pertains to in the listed capacity. So the more that we can evolve our business, be creative in products, and I think is helping, and I think that we're seeing that transition happen. I think, speaking to the European institutional investor base, we've also witnessed that. The ability from Cboe's perspective to take a look at what are some of the roadblocks associated with those investors investing in sector ETFs or sector indices, and there's a UCITS framework that limits the ability for them to invest in ETFs. So if you create a framework or UCITS framework from an index perspective, I think that allows that entrant to now start to deploy capital. And so that's where some of the growth is coming from our perspective.
You guys have mentioned new products and European demand and things like that. John, I've talked to a few people about new products and being able to launch new products. The OCC, if they're rebuilding their technology, people are alluding to that'll help them launch new products and do more. Can you talk a little bit to Renaissance and how that will help the industry grow and the brokers and market makers do more?
Yeah, I'd say, listening to all this, and as the foundation of secure markets, we're constantly trying to look around the corner and see what's coming, right? And so when I'm thinking about all the innovations that you guys are doing, this is new volume that's coming to us, and how do we think about being able to digest that? And when I look back at the ecosystem from more of a top-down approach, it's that the concentration at the clearing firm level, that's really probably the largest area of concern, to make sure, how do we make sure that there's that capacity within our clearing firms to support the market makers, to support this order flow, and be able there to digest that. We are looking at multiple levels. So on one hand, how do we start thinking about capital efficiencies? While we're building out our resilience, we're also looking for efficiencies, and a great example of that would be the clearing fund. So last fall, we implemented a new clearing fund, which moved us from a cover 1 to a cover 2, so significantly enhanced our resilience. But at the same time, we're looking for enhancements within the model that effectively allowed us to return $3 billion in capital back to those clearing firms, increasing capacity there. Renaissance has got the same theme. So now we're pivoting more towards operational efficiency. So how do we think about taking our legacy 15, 20-year-old clearing system, adopting new technologies, and start to bring efficiencies there? One of the key opportunities for us is to try to accelerate and reduce kind of the overhead associated with adopting new products. So we're starting to look at the process of clearing, of digesting a product into the clearing process. What are the long poles? How can we automate those processes? How can we bring efficiencies there so we can reduce the time to market and the costs associated with new products? We're looking to leverage the cloud to enhance our scalability and recoverability in a cost-effective manner. So using technology to enhance our scalability, automating controls so that we can do more with less human intervention, lower cost, all of this with the end in mind of trying to get to a lower per contract cost long-term run rate.
New products, innovation, obviously, Shelley, you guys had a big announcement yesterday with spikes and the listing of futures on MGX. Why is that a game changer for you guys? What does it allow you to do? Is it a new, is it a product that'll get legs because of that future side of that?
We believe it is a game changer. One, we're bringing competition to an asset class that has been dominated by a single product, and we know how incumbents don't like competition. But to be a viable product, we have to have a future, and I think we formed a great partnership with MGEX. It's a great opportunity for us to list the future that's the sister to the options we have listed on MIAX. NASDAQ has a product coming that's going to be competing as well. Competition encourages growth. Becomes cross margins and cross trading between products. The entire asset class can grow. But it also allows us to list additional products. We haven't had a single list product before. So we had to make some changes to the systems and risk protections to facilitate that. But again, it's all part of the healthy growth of the industry. We're all up here working together to make the industry better, but we're competing with each other as well.
New products, getting new people to trade options. I mean, how do you build that demand? As an industry, what do we need to do? What do you guys need to do to get more institutions involved, international investors involved? Is it actually MIAX is only exchange without a trading floor box? Pat, you just launched a trading floor last year. Is there a role for that segment of the market? How do we get more volume from new sources as opposed to just creating new products that are like each other, or maybe building liquidity or taking liquidity from existing players?
I think this actually stems from, it can go back to the effort that Mary Savoy and OIC are doing from an industry perspective that still continues to be a mainstay and an ability to help facilitate growth within the industry. And I also think that, the sell-side constituents and even the retail firms all do a fantastic job of educating and boots on ground in terms of creating not only content, educational materials, and the ability to host seminars and roundtables to educate existing as well as new entrants. But I actually also think that it doesn't just stay with those individuals or those participants in the marketplace. I think that in my newer seat at CBOE, I think that it also is a concerted effort and a strategy that we're going to take to place a further initiative on the exchanges to educate. That while we respect and understand the relationships that a sell side or a retail brokerage has with their end user, that the exchanges can also help facilitate that growth by not only having those those seminars, and as well as also strategy and content sessions that allow for further growth that not only will facilitate more volume for our own exchanges, but for all of my colleagues' exchanges, and the ability for our sell-side banks and other participants to be able to interact with those new users. If we have more people and more boots on the ground, the ability to facilitate that growth, not only domestically within North America, but in Europe as well as Asia, we will all see the benefits of that. So not only just out of respect to what OIC is doing, as well as the sell-side banks and the retail firms, but I also think that it's important initiative that should be taken some ownership on the exchange side.
I was going to say the only other thing I was going to add is from the perspective of education, it's an obvious and important and perpetual answer, right? In order to make sure that we have people understanding and further engaging in the product. And something that was kind of interesting in one of the retail brokerage firms' earnings reports recently, they were talking about how they were leveraging education and the fact that their engagement using educational products on the platform was like up 60% year over year. But the thing that I found really interesting was the fact that they were now using some machine learning and artificial intelligence algorithms to understand a client's portfolio, understand how they're trading, and deliver content that was more customized to their interests, the content of their portfolio, et cetera, which is really interesting in terms of making the education more actionable and relevant to the end user. And so, we see that application every single day in terms of our ability to subscribe to the news feeds that we want to see or the content that we seek, et cetera. And so it's only natural that you take that application to education as well, which I thought was pretty interesting.
Aside from the education, you also need the liquidity source to be there with you. So what you're doing is you're working with typically a partner like an index provider to come up with a nice concept. Then you do a roadshow with the demand side to ensure that it meets the needs of the customers. But in order to have a successful launch and product, you need the liquidity side there right with you to ensure that, you know, when the customer does bring up your option chain, that they see a tight bid offer and they're ready to act, and that the liquidity is there with it. So, you know, we launched a new product back in June, which is the 1/5 size of the NDX contract, which is notionally a complement to the NQ futures on CME. And we've been really happy, got great feedback about it, and done a ton of webinars with the street. But the reality is, to get it perfectly timed and aligned with, you know, the bank's interests and then the market makers also to be able to provide that liquidity out to the marketplace does take time. And what I'd advocate to my peers here is that just continue to support your products and continue to work at it. It's not an overnight trick, and to turn it into success.
Yeah, the key is definitely education. To everyone in this room, options are second nature. To most people, they're not. The Options Industry Council does a great job. The CBOE's Option Institute for many, many years did a great job educating people. I would encourage all of you that run retail or institutional firms to reach out to us at the exchanges. We're happy to work with you one-on-one and help with the educational process, introduce your clients to other ideas, and it's all about educating the end user.
All right, we got a couple minutes left, and I'm going to ask each of you to look in your crystal ball or looking backward over time. If you could roll back one market structure change or evolution or thing that happened in our options markets over the past decade, what would it be and why? But before you do it, you can't say too many exchanges. Because guess what?
We have the right number of exchanges now.
Yeah, exactly. There's going to be more exchanges in the option space in the coming years. I hate to break it to everybody in the room, but there's exchanges out there that are looking at this. There's new exchanges that are launching in the equity space that, you know, I assume in their business model there has to be an options component to it because there's already you know, a lot of attention on the option space now. So with that caveat, I'll throw it, John, if you want to go first and go right down the list. You know, what's that thing you wish you could erase?
Well, I'm going to say the Collins Amendment. So Collins Amendment is an amendment to Dodd-Frank that effectively said banks can't use their internal model trying to create a level playing field between large banks and small banks. And what that effectively did was force all the banks who had internal models that can handle more complex products like derivatives to use the current exposure method, and which was really kind of the impetus of why we're dealing with this SEM versus SACR issue and a lot of the capital constraints that we're seeing today. So if we could roll back that Collins Amendment, that would have saved us all a lot of pain.
Okay.
I'd say the permanency of the price improvement auction made that in stone, that this will live on for a long time. The commission did not really have the adequate data to measure the effects of the use of price improvement auctions, and here we are, and it's going to live for the next, you know, decades plus of time.
Personally, eighths and quarters. I'd still be on the CBOE floor if I still had eighths and quarters. Realistically, QCC was damaging the marketplace. The U.S. markets thrive in transparency. We don't want to become like the European markets where things are all crossed in the dark. It's allowed in the equity markets. We've not allowed it in the options markets to QCC. I think that's taken a lot of opportunity away from the market-making community.
I just think from a high level, just some of the unintended consequences in general from the fallout from the 2008 financial crisis, just the financial reform and all the regulation that came out of there. It seemed like a lot of it was, you know, necessary, but at the same time, maybe it was overprescribed and kind of putting the genie back in the bottle there and just freeing up some of the capital to incentivize liquidity provision.
Well, I guess the burden of being fifth in line is you have to be a bit more creative with your answers. I would pick a sort of more nuanced component of the price improvement auction piece, which is when they were originally introduced, there was always a requirement to improve over MBBO. And then there was an evolution where it was deemed okay to start at the MBBO because the opportunity for price improvement was almost as good as the guarantee. And I think that creates, or it did create a distortion where a market maker could be at a price and have an auction go off on the tips and then wasn't able to trade. And so I think it gets back into what I was talking about earlier about the appropriate use cases of auctions and the parameters by which they exist. So.
I agree. No, as the anchor here, I think I would actually go along the lines of what John spent. I spent a lot of time. Maybe I don't have as big a passion as Steve Crutchfield with regards to the current exposure method, but pretty darn close. But I do think that few do, and we appreciate his passion and love and desire to actually roll that back or improve it. So I think the need to look forward towards SACR, maybe not even go down have the current exposure method in place, we probably would be in a much different state today.
Great. I think we have time for a couple questions for the audience. I would be remiss not allowing at least one or two, so if there are any questions, please stand up.
So one thing you guys have been saying is that payment workflow, pull that back. So why do assume that payment workflow is good for the market overall?
Did you guys, I missed the first part of that question. Could you repeat it for the mic, please?
So one thing I didn't hear that nobody would roll back is payment for order flow in general. Obviously, auctions are part of that. So am I to assume that you guys all think that payment for order flow is a good thing for our market and is good for competition?
Who wants to start? It's become part of our market structure. Maker-taker is another form of payment for order flow. It's payment for providing liquidity. Our markets run on financial incentives. There's some firms that choose not to take payment for order flow. I believe that the firms that do take payment for order flow are very cognizant of their best exit requirements, and that's the most important thing, is the customer getting the right price. Does it matter what venue it trades on for the customer, as long as the customer gets the best price? Probably not. What are the economic incentives to route an order? It's just part of the market structure, how it's evolved. I don't think it's necessarily evil, but firms would not abuse their best exit obligations just to get payment for order flow.
Any other questions? Just one back here.
How about an idea of being a little creative
and for the Doug Engman from San Francisco, eliminating the professional designation for traders who want to trade at the bottom 50% of listed names. Because you're excluding a lot of very, very smart traders who the big market makers don't like because they think they get picked off. But these are traders who like to trade. Let them trade in the bottom 50% without having to worry about those trades counting against their professional numbers.
I think you raise a great point. Obviously, we recognize, some of the industry concerns or some of the impacts and some of the regulatory things where you saw, a finite amount of liquidity providers. So what happens to a lot of those liquidity providers is they maybe go into a professional capacity or they go upstairs and they trade themselves. I think you're seeing a growing number of those customers, and I don't think I think the industry should probably continue. And I think Andy was going to ask one of these questions of us about let's call it one-sided liquidity, and I actually view that they are actually good for the industry, and I do believe that from a passive perspective that those investors are ones that are providing liquidity to the screens and the marketplace in a way that's more efficient for all the end users in terms of better execution quality. I recognize your point, and maybe that's something that we can take into consideration in terms of that subset of underliers, especially if those are the ones that are very infrequently traded and could potentially warrant some changes. I would look to Paul Giancotti and Longschwag to potentially take a look at that effort as an industry as whole, and I think it's something that they should evaluate for all participants.
Great. Well, we've run over, so I just want to thank you all for joining today and talking so freely. Really appreciate it. Thank you very much.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.